Good morning, my dear students. This is the Unit 2, class number 9, and the topic is SEBI guidelines for IPO issues, and the subject is financial markets, institution, and services. My dear students, in previous classes, we have already discussed regarding the new issue market or IPOs and some of the players regarding the which is related to new issue market or primary market or IPO market. But question is what are the SEBI's guidelines? As far as the SEBI's guidelines, there are generally three types of investors which are to be associated with the new issue market. One is a retail individual investor, another one is a non-institutional investor, and third one is qualified institutional buyer QIB. These are the three investors are the important players in the particular new issue market as far as investment is concerned. Means when you see the particular advertisement of the new issue or IPO issue of a particular company, you see in the means in the front page of the particular IPO advertisement, there is some percentage is written, what is the QIB percentage, and what is retail individual investors percentage, and what is the non-institutional investors percentage is written over there. But the question is who is called as a retail investor? Means the retail investor means an investor who applies for the shares or securities or investment in a particular company whose value is not more than rupees 1 lakh. But as far as the SEBI's guidelines 2000 has doubled the particular limit of 1 lakh to rupees 2 lakh, means the investment value should be within the limit of 2 lakhs. But the minimum application size for the retail investor has also been increased from existing 5,000 to 7,000 to 10,000 to 15,000. Means application size means that is the investment pattern through which the retail investor can invest. My dear students, and second one investor is called as a QIB, qualified institutional buyer. Who is called as a QIB, qualified institutional buyer? A bank or a registered board or a foreign institutional investors called as a qualified institutional buyer, and also the venture capital fund which is registered with the SEBI, and the foreign venture capital investor registered with the SEBI, also called as a qualified institutional buyer, or under the IRDA, Insurance Regulatory Development Authority, some of the insurance companies also called as a qualified institutional buyer, or any provident fund with a corpus of 25 crores, or pension fund minimum corpus of 25 crore, they are also called as a qualified institutional buyer. But as far as in those who are not covered under this category of retail investor and qualified institutional buyer, they may called as a non-institutional investors. So there are three types of investors are associated with the new issue market. One is retail investor, and second one is QIB, qualified institutional buyer, and third one is the that is called as a non-institutional investors. Means investors who do not fall within the definition of above other two categories, they may be called as a non-institutional investors. Next important concept as regards to SEBI guidelines is minimum promoters contribution. What is the minimum promoters contribution and what is the locking period? There if it is divided into two parts. One is for the listed companies, another one is the unlisted companies. First one is the unlisted companies, and which is the new type of company or new IPO, which are to be the funds are to be raised. These type of companies, the promoters of a particular company must contribute at least 20% of the post issue capital. Post issue capital 20%, and the lock-in period at least 3 years. In this period is also called as a lock-in period, or means which represents the freezing of such share for that period. Means this is the after 3 years the promoter can sell their stake or sell their scrip to the outsiders. And what is the list for the listed companies? Similar, the promoters of the company must contribute at least 20% of the post issue capital or 20% of the total issue size. Means this is related to FPO, means follow on public offer. It means for the listed company, those who are registered with the stock exchange, similar or same guidelines as follows, or which are related to the unlisted companies. And next one is the some of the keywords which are related to public issue. What are the keywords? One is the offer document. As you know, offer document means this is a prospectus and which can the relevant information about the company. And sometimes some price band is there, means 140 rupees to 145. 140 rupees to 145 means within this price the particular investor can invest. So that it is called as a, it is the price band may be called as a book building price. That is also called as a book building price, and it is the range of price within which the investor can bid for securities. Another price is cutoff price. What is cutoff price? The price is decided by the issuer with the consultation with the merchant banker. It means cutoff price may be called as a fixed price through which the securities will be offered, or the security price can be determined, or this through this way the funds can be generated through this price. Another one is a floor price. It is a minimum price or bid which can be made for IPO. That is called as a floor price. Means that is called as a, it's a open to market or open the floor through which the particular price can be or the bid can be decided. Another one is face value. What is face value? It is the minimum value below at which the price of stock won't fall. It means it is a fixed value through which the particular scrip price cannot be fall or cannot be below the particular value price. That is called as a face value. Another generally the concept is the regarding the SEBI guidelines as regards to pricing issues. There are two types of pricing issues are there. One is fixed price process, another one is book building process. But sometimes some companies are used book building process and some companies are used the fixed price process. The question is what is fixed price process? Means the price is fixed by the company and the securities before issued is brought to the market, means it is fixed by the company. And but book building process, or it is a price cap, you may call it as a price cap. It is also determined price of a specified securities with a consultation with the merchant banker, or through book building process, or the price cap is determined. That is called as a book building process or book building pricing issues are there. It is a one method. Generally two method are there. One is fixed price process, another one is book building process of pricing of scrip or pricing of the bid. My dear students, sometimes some issues are related to pricing. The price is in the public issue, it is prescribed by the SEBI with the consultation with the merchant banker through to this way the price can be determined. As I have already discussed regarding the fixed price process, And in book building or price band, it is also process which are used by the marketing of a public or equity share of a company. Means the issue price of a security is demand and supply forces of the capital market. Means demand and supply means the particular company's say, if the company share is more demand and more means investor are more interested to take participation in the particular issue management process. In this way the book building price can be determined. Sometimes the price at which securities will be allotted is not known to the advance to the investor. It is a only indicative price range is also known. Indicative means supposed to be this the price band is there, or price 140 to 145. Means it also called as a price band. It should not be more than the 20% of the floor price. It is the one rule. It should not be more than 20% of the floor price. Next, as far as guidelines of the SEBI 2000, there are several means concepts as regards to the particular process of the IPO process of pricing. One is how far is it is managed. The issue management 100% should be put through the book building process, 75% or maybe 75% through the book building process, or 25% of the book building process. Means 100, 75, 25, any of the three terms you can choose any one. And another percentage, suppose 100% book building means there is no retail investor and there is no institutional investor. If it is 75% book building, that is another two participants have to be come up, that is called as a retail investor and also non-institutional investor. If it is book building is 25%, similarly retail investors getting more scripts or more bidding of a particular issue management, or more participant, and non institutional investors also more participative in the particular issue management process. My dear students, it means it is a one way through which first focus through the book building, and next through the retail investor, and next one is the non-institutional investor. This is the way through which the particular pricing can be made. Another one is there are different guidelines as regards to IPO, as regards to entry norm. One is a profitability route entry norm number one, and QIB route through entry norm 2, and appraisal route, that is entry norm number 3. Means through profitability approach and through QIB route approach, through appraisal route approach. My dear students, if you see through the entry norm number 1, there are that is called as a profitability route, and there are some of the following guidelines as regards to through IPO to be followed. What are these? The rule says the minimum net worth of the issuer more than 1 crore in each previous 3 year. Means those who are issued the particular type of raising of funds, their previously 3 years rupees 1 crore, their net worth should be, company net worth should be 1 crore last 3 years. And next one is the net tangible asset of the issuer must more than 3 crore each, asset position 3 crore each, and not more than 50% of the asset must be held in form of monetary previous 3 years. Means 50% should be held as a monetary assets, means convertible liquid assets. And the third point is the minimum average operating profit before tax should be 15 crore at least 3 years out of 5 previous years. Means last 5 years or 3 years in 15 crore profit should be earned. And the issue size not more than 5 times of the pre-issue net worth. Means issue size should be pre-issue net worth, means in previously it is stated 1 crore. It means the issue size should be a cut off time of that is called as a 5 crore, means that is called as a 5 times, means 1 crore net worth into 5 is equal to 5 crore should be there. If the company is changed to its name, minimum 50% revenue should be previous year's received should be taken into consideration, and additionally some of the ease of doing business is allowed to the company to fulfill the requirements. This is the as regards to profitability route of entry norm number 1. Another one is through QIB route or qualified institutional buyer route, entry norm number 2. What are these? QIB, qualified institutional buyer, or it's may be called as a through via book building procedure. Similarly, as I have already discussed, 100% through the book building, or 75% through the book building, or 25% of the book building. Means under this process, 75% of the company's net offer to the public must be allotted compulsory to the institutional buyer. Here stated 75% is compulsory. Minimum subscription or through QIB or book building process should be 75%. Means, but in previously what rule says? The rule says say 100%, 75% and 25%, but here says compulsory rule is the 75%. Means 70, if QIB through the fund can be raised 75% and other 25% will be divided among the retail investor and non-institutional investor. This is the very important criteria and a very important rule as regards to the public issue management. And next one is the, my dear students, next one is the appraisal route and entry norm number 3. What is the appraisal? Means the, it's a appraisal means the project appraisal or project verification. Project verification means economic or technical or financial or the through which the particular project will be appraised and participative in the particular type of issue management. What he says? He says 15% by the financial institution or scheduled bank, or 10% of comes from the appraiser. Means financial institution can take participation only 15%. Another one is their contribution to the minimum post issue for the face value of capital will be 10 crore or mandatory market making, and therefore the last 2 years. It means, and the prospective allottees should be 1000 prospective allottees to be issued to the company's public issue. Means these are the related to the appraisal route. Appraisal route is always related to financial institutions and banks who can check the or freedom to anticipated appraise the particular project, and they say only 15% minimum financial institutions or commercial bank or scheduled commercial bank, and 15 extend to 15%, but minimum 10%, minimum 10 to 15%, these through which the fund issue management can be made, and 10 crore for the or market mandatory market making must be there for the last 2 years. Next one is the, another one is some of the SEBI guidelines or public issue for the listed companies. What are the listed companies? As earlier said, listed means that is related to FPO, follow on public offer or further on public issue. And if a company change their name at least 1 year, 50% revenue as already stated, and if the size of issue not more than 5 times as already stated, this is the regarding the FPO issue of issue management. And some of the exempted entities under SEBI guidelines for IPO. What are the exempted entities? Now the exempted entities are, they are called as a the private and public sector banks and infrastructure company. It's a project appraisal by the financial institution. These are can be exempted from the particular type of public issue management. And some of the general guidelines of SEBI for the IPO. What are the general guidelines? application should be filled and listed in a particular recognized stock exchange, and the company must enter into the legal contracts with the depository for dematerialization of securities, and partly paid up shares must be fully paid up, and listed must be minimum 25%. 25% if the fund can be raised, then only the it can be SEBI guidelines as per the it can be made. Another one is the process of initial public offer minimum 50 lakhs and must be start with the company of a draft in form of draft of red hearing prospectus with the SEBI. And so, these are the some of the guidelines, and the company must choose the book building process under the entry number 2, and the 50% of the board of director must be independent in the investors. Another one is, and 50% of the board of director must be no obligations to the promoters of the company, and no director or promoters of a company must be no must not be guilty of any economic offense, and it must not be called as a willful defaulter, and the issuer of a company must disclose the number of shares in the disclosed to the number of shares specified, and the company, if the company wants to go for a public issue 100 crore, it must submit a draft document to the regional office of the SEBI. Doing so means 100 crores above the public, if the public issue management, then draft offer document that is called as the prospectus should be submitted to the regional office of SEBI. And some, and last part of the SEBI guidelines, that is called as a IPO grading, means all IPO should be graded as far as the it is regulations is made by the SEBI. Means the IPO grading is a grade assigned by some of the credit rating agencies and registered with the SEBI for the initial public offerings. There are grades are there, 5 grades are there. One is IPO grade number 1 for the poor fundamentals, IPO grade number 2 for the below average fundamentals, and IPO grade number 3 average fundamentals, IPO grade number 4 above average fundamentals, and IPO grade number 5 strong fundamentals. Means IPO grading has been introduced to check out the particular means assessment of the equity issue offered through the IPO. Means how far is the IPO is more riskier or more positive note with regards to the issue management process. My dear students, these are the basic concept of the IPO process or SEBI guidelines as regards to IPO. My dear students, as far as you know, the market is divided in two parts. One is a primary market, another one is a secondary market. And in the primary market, that is deals with the players of the primary market and SEBI guidelines regarding to the primary market and nature and concepts of the regarding to the primary market. But in secondary market, that is called as a stock exchange, and how far as the stock exchanges are operate smoothly in the Indian capital market. Thank you. If any question, you can ask me. Thank you.